My name is Stacy Lynn Shriver, and at home it's Mrs. Sinclair, but I wanted to say hello to everybody. Welcome to Navigating Homeownership. We had about 45 registered for tonight. I got a lot of text messages today that, this was going on or this going on, you're going to have it next month. The answer to that question is yes. We have Navigating Homeownership, the path to owning a home, the first Thursday of every single month at 5:30. So if something it didn't work out for their schedule or something like that, then they can certainly participate. What does happen is if they did register and they're not here, Anthony always sends out, or sometimes Kelly, they will send out an email and say, hey, we're sorry, we missed you, or here's the information. The next month is at this time. So a shout out to our team members, a real quick introduction to some team members that are on the call. We are an interesting branch. Our Premier Nationwide Lending branch our hub branch is located in Flower Mound, but then we have like tentacles in different areas of Texas and Oklahoma. So there are other loan officers on the call. So Philip Price is in Lubkin, Texas. So he does everything East Texas. So if you want to buy a pine tree and a house, that guy's going to hook you up. There you go. Located tonight in McKinney, Texas. Also licensed in Oklahoma is Anthony Glenn. Here with me in our Flower Mound office, our branch admin operations person is Kelly Campbell. Kelly really is I always say she's the big toe. She said she's working out to be promoted to the right arm. I don't know, but she orders all the appraisals and she does a lot of stuff for the whole team. And Ken Melber, I saw him. Ken is in Spring, but you never really know where Ken is because he's probably at the beach. Says he does beach properties and second homes and does all kinds of stuff. And then Deanna Adams splits times between Texas and Pauls Valley, Oklahoma. I saw her on here. And is there anybody I missed? I don't think, except for Ben Sinclair, our Friendswood Pearland expert. And he is in our Flower Mound office this evening. But this morning, he was at a meeting in Pearland. So that you want to ask, he had a rocket ship up 45, I think, today. So there's
Stacy, I'm here.
And Denise, I just saw Denise pop in. There you go, as I was saying it. There's Denise. So Denise just popped in, and Denise is the loan officer in Pearland. So we have a lot of our team represented. So that's exciting. So when I start navigating homeownership, I typically start by explaining that one of the things that the reason I'm an advocate of homeownership so much is that I was raised in Arlington, Texas, and my parents rented my childhood home for 19 years. So I always share that story. But tonight, I really want to start off not only by talking a little bit about that, but I really want to give a quick introduction and have a home ownership story told by none other than Anthony Glenn. And so I will take it away. This strapping young fellow in the picture, Mr. OU grad and fan. I got to get over the fact that he's an OU person. Go Frogs, right? But I'm gonna turn it over to Anthony for him to share a little bit of a home ownership story with y'all.
All right, thank you. So that picture was taken whenever I was at the ripe old age of 27 years old and my first trip to the Rose Bowl with the Oklahoma Sooners. That also was right around the age that I purchased my first house, which you can see there just to the right. Purchased that house in McKinney, Texas. Got to pick the lot. Got to pick the shade of white choices that they gave me for paint color of the walls, and paid the purchase price on it. So back in 2003 was $130,000.
Okay, say that again so everybody heard it. McKinney, Texas. How much?
McKinney, Texas in 2003, brand spanking new, was $130,000, give or take, $500. It was right around 131, 130, something like that, brand new. So unbeknownst to me, about a year later, I met my wife to be, and she had a slightly larger home than I did. So when we got married in 2005, I ended up moving into her home and ended up keeping this one, and I chose to rent it out. And so from 2005 to around the year 2017, I rented it, let somebody else pay the mortgage on it, and gained equity. The value of it increased. And then 2017, the lady who had been renting it from me, she'd been renting it for about 4 or 5 years. She ended up purchasing it from me for $240,000. And then I noticed, I followed her on Instagram. She was kind of a friend, even though she rented and then, purchased from me, and followed her on Instagram, and remembered in 2020, after she'd owned the home for 3 years, she posted something on Instagram that just warmed my heart. She posted this. She said, 11 years ago today, I moved into this house with a 7-year-old boy, newly single parent, new job after being a single at-home mom for 7 years. I was a hot mess. I just knew that this little rent house was a blessing and would be our new home. I wrote in the back of my planner that I wanted to buy my home within 5 years. It took 7, but I did it. I bought our little house and all by myself. Never give up on your dreams. Love grows best in little houses. Hashtag single working mom. Hashtag dream big. Hashtag never give up. So I know that she lived in it after she purchased it for about 5 years, and then she sold it in 2022 for about $320,000. So it had appreciated to the point to where she was even able to make some money off of it as well. So my story has a story within a story. So it's just a great story of home ownership.
And that's a wowzer. I mean, how many of you guys realize that we can't go buy a house in McKinney now for $130,000, and that's crazy. And also just, I think when Anthony and I were talking about this particular story, everybody has a story, but when we were talking about this one, I really spent a lot of time talking about the value of $1. So like, look how much that dollar, along that journey, and the impact, that had in home ownership. One, he had a house that he could rent, and then he had an opportunity to sell it to the renter, so I thought it was a really great story to share. I don't know how many of you, and you can use your show of hands in your Zooms, but I don't know how many of you had to share a room with a sibling or share a bathroom with your sibling when you were growing up. But when I was growing up in Arlington, Texas, my address was 1920 Westview Terrace, and this was the bathroom, and this was what the bathroom looked like. And oddly enough, this is what it still looks like. And so I shared a bathroom with my brother, and I recently remodeled a bathroom in my home in Flower Mound, and I told my husband we were going to get this lime green tile. I loved it so much. We did not, but I did say that. So, but our team and kind of what we stand for when we talk about housing and so forth is, by wisdom a house is built, and by understanding it is established. Proverbs 24:3. So, my parents rented this bathroom for 19 years. So we're excited to be able to kind of navigate some waters with y'all tonight, and, and see what different dreams and hopes that you may have. This is me outside of mortgage. This is my husband, Ben, who's a loan officer. That is our daughter, Landry. She's 11. And then our son, Zach, who went into and graduated A school in the Navy in the reserves, and he's still serving in the reserves. That was a picture that was taken a year ago. I think she's grown a foot since. And then we always provide a little bit of a disclaimer. We work with a lot of realtors. I'm excited to see some on the call tonight. So when I get to the last section, I may call on a couple of you to comment. But I always provide a disclaimer. As a lender, compliantly, we work with all kinds of people that don't necessarily work for our company. But I can assure you, when we put ourselves in a position where we partner with title companies and realtors, insurance, and all of that, we definitely work with the best people we can find. But we also provide a disclaimer. We're responsible for our loans and rates and the commitment to lend. And our team, all of our team, Deanna Adams is on here. I mentioned that. Deanna and Ben, myself, Philip used to be an appraiser. There is a lot of us. We've got 20 plus years each individually. But as a group, I think we calculated it the other day that we have like 88 years of experience, which frightens me really. But because I started when I was 12, all of them started, I was much younger, just to be sure we all know that. We're excited about some of our certificates, our certified veterans loan specialist, we lean into special programs, down payment assistance programs, and best in Denton County here in Flower Mound. And also I have my CE. So sometimes with realtors, you'll see me offer some CE classes for your hours. Let's dive right in. Investing in your future. The topics that we're going to talk about tonight. Should I consider buying a home? Am I able to buy a home? How do I get started? And what is the path from loan application to home ownership? So I want to say this. Recently, I write some articles that go into the Town Live magazine, and I recently wrote an article about time. And, time is not infinite, but it's also not impossible. So when we go through this whole class and as we navigate the waters, just understand that everybody's situation is a little bit different. And we want to be able to make sure we answer all your questions. But if there's questions you have after this that relate to these discussion topics, please reach out to us, because again, was not raised with home ownership, did not get home ownership until I was in my young 30s. My mom did not own a home until she was in her 60s. That when I say time is not infinite, but it's also not impossible. If my mom had said, I'm too old to buy, then she would have been in a situation where she would have been wrong. Now she's 83 years old, has a great deal of equity in her home. So rent versus buy, the cost of renting. So I've had a lot of conversations just this week with various people, and the rent situation is not getting any better, right? It's not improving. So when you look at the cost of renting and the money spent over the cost of renting, so I use my family and my parents as an example. My dad wanted us to stay in the same school district. They were in a situation where, it'll look better in 6 months. It'll look better in a year. Me and Steve and Deborah and several realtors that are on here, we all had customers that when the interest rates were 3.5 and 4, they were waiting for it to get better. Wait till we get better. So the reason I show this chart is that just like with my parents, when I calculate the amount of rent over the course of 19 years, by today's financial standards, they spent $497,000 in renting in that time. So when you look on this chart, some of you are paying monthly rent, and I felt like we're conservative because I talked to several people this week where their rent was $2,600 a month. But this just gives you an idea over the course of 1 year, 5 years, 10 years, 15 years, at $2,400 a month, you are spending $432,000 on rent. So what we try to do is we try to let that land a little bit so that we can help guide and make a plan to come up with what is the best thing for time. And we also spend time not trying to talk about, we want people to help make decisions based on today and based on their family situation that will impact your family for the next 3 or 4 or 5 years, maybe 7 years, but not look at it like, oh my gosh, I've got the same loan for 30 years. I can, certainly I would ask, I guess, Anthony, because he just told his story. Anthony, did you have the same loan the entire time on that house?
No, I did not.
No. Did you refinance?
Yes.
Yes. So there is that opportunity. It's not, most people don't have the same loan for 30 years. I know that on my house, I have not. I also get this conversation about housing prices, and people are worried about, well, wait a minute, what if I buy the house and it doesn't, increase in value, and then I'm stuck, I can't sell it. So I'll just let Deborah speak to that for a second. Deborah, do you think we have a value problem in the Dallas-Fort Worth area?
No, our values have gone up. And, I think historically, if you go back 20, 25 years, in the Dallas-Fort Worth, like right here where we are, there was one moment where it dipped for a second and it went back up. So historically, over the course of time, home values, it's always going up.
Yeah, we're very insulated in Texas. And now y'all might have noticed we have a lot of people moving here from California. So our housing prices are stable. They continue to be stable, and they increase in value. So I get the fact that the cost of housing has gone up. Interest rates are higher than what people were used to, in the last few years. But I will tell you, the interest rate on the house that my mom is in Flower Mound, and when I first did that loan, that interest rate was like 8 or 8.25. So we have to put interest rates in perspective. And we'll talk a little bit more about that when we talk about taxes. But really, the housing prices, the double digits, and also the value of housing is going to continue to grow because people want to live in Texas. So we've got that coming here. And I do want to speak to the fact that, I know I mentioned Dallas-Fort Worth. I know on this call, we get a lot of different areas. So in the chat, let us know where you're calling from, because I know the last time We had people from Longview and Midland and all over Texas. So whatever area you're in, and our company is licensed in like 18 states. So I'm sure we'll take care of you. I always say, ask your brother, ask whoever you want on the call. So am I eligible to buy a home? These are the factors to consider for loan approval if you are eligible to purchase a home. And so what I want to do is ask one of my loan officers to speak to these 3 things real quick. So I'm just going to run through these things. So factors to consider for loan approval: credit. So I literally, right before this call started, I was on the phone with a customer, and that guy was asking me right before we got off the phone. I was explaining how to apply, and I'll take a look at it. We'll get back in 24 hours. He's like, wait, is it a hard pull? And the answer to the question is yes. It's going to be a hard pull on the credit so that we can see what your monthly obligated debt is divided by your income. I have another screen for that here in a little bit, but yes, those are things that we consider as factors in being able to purchase a home. We want to see what the credit is, the score. The other factor is down payment and closing costs. I ask this question every single day, especially when I have referrals from realtors who provide us referrals. The question I ask every single time is, how much of your own money are you planning to use towards the purchase of a home? We ask it every time, because if the answer is a couple of $100s, then you're not ready yet. And we don't ever want to say no. Sometimes we have to say not right now, and again, that comes when we get into a plan. But we're going to talk about down payment, and we'll talk about closing costs, and maybe there are certain ways that some of those items are covered with programs. But at the end of the day, we want to make sure that you have enough for down payment and closing costs, and that the credit meets the guideline standards to be approved for a loan. Debt to income analysis. We're going to analyze and give you an analysis of all the monthly obligated debt. We're not, as a lender, we're not always as concerned about the balances as we are about what you are obligated to pay. And I've had conversations with people where they're like, well, I'm paying more than that every month. That's great. But what we're concerned about is what you're obligated to pay. So we calculate that. And so we have to have an analysis. So we have to run a credit report to be able to see that.
Somebody has their hand raised, Stacy. It's Vitali Katarino, I think is how you say the name.
Colleen,
Hello.
hi, how are you?
I'm good, thank you. I'm not sure if this is the right time to ask, but I had a question about credit scores.
Okay.
So my question is, I make full-time payments on my credit card balances every time, but I noticed that my score just keeps coming down, and then up, and then down, but it never just keeps going up, and I don't have any debt. Why does that happen?
So that's a great question. I think everybody has a case-by-case situation. I think sometimes when there are people that say you should have no debt, and then the problem with when you have no debt is that we don't have anything to measure. So what I would say is that sometimes it does help if you go to a bank and you get a secured credit card where it is protected, like you've given a $500 balance deposit to get that secured card, then you can use that card to go buy groceries or buy gas and then pay the card off. So then there's something to measure. The factors, and it's what your question is so great because of the timing of the slide that I have here. Factors that affect your credit score. It's almost like I paid you to ask that question. It's such great timing. So, but factors that affect your credit score are paying your debts in a timely manner. So payment history is absolutely hands down the most important part. It's 35%. So payment history is so important, which it sounds like you have that. So that's good. But when paying things on time, I think sometimes I'll talk to people and they're like, I'm only late on a few things. And I know that Ben had recently a customer where they'd paid something late and it impacted their score by like 60 points. So you've got to pay things on time, keeping your account balances low compared to your approved credit limit. We don't want to have a credit limit of $1,000 and charge it every month to $995, and then pay a little bit down. So when you have variances on your credit report, but the limits are maxed and you don't have much credit, then sometimes that can impact your score. Credit scores will change and evolve. They don't always stay the same each month. A longer credit history can increase your scores. Sometimes what we will say is when you've got a teenager that's 18 or 19 years old, if they become an authorized user on a parent's account, and by the way, parents, you don't have to give them the card. Don't hand over the card, but you can make them an authorized user. And if they're an authorized user, then they then also adopt the good credit history of the parent if it is good, and they can also adopt the history. So when the longer history that you have, longer credit history, that will help increase your scores. Good management of revolving credit, revolving credit, be it credit cards, of that nature. Opening new credit accounts or credit inquiries can negatively affect your credit scores. So as a lender, we have to pull credit. It's a hard pull. But what impacts people's credit scores is when they go and they get multiple credit pulls from multiple different sources, because the codes are different. So you go down to Kohl's and you run credit there. You've done a mortgage pull. Then you decide you're going to try to buy a car. The FICO system says, whoa, wait, hold on. They're trying to incur a bunch of debt at the same time. And so when that happens, that will then have a negative effect on your credit. Is there anyone else that would like to speak? Philip or Deanna, would you like to speak to her question?
I can
speak.
Yeah, Ben, go ahead.
Yeah, go ahead, Ben.
So sometimes it's better to keep a small balance on your revolving debt. If you pay everything off and just let it sit there, with no activity, your score will go down due to lack of activity. It's hard to tell you specifically to answer your question without looking at your credit and seeing what you've got. You need one installment account, like a car loan, and at least two revolving accounts. You want to keep your balances below 50%, really below about 20% of your available revolving. My phone is going off. And, but it's hard to tell you without looking at your credit for sure. But if you're paying everything down to zero every month and it's just sitting there, remember when you look at your score, it's a point in time. It's whatever it is at that time. So, and you don't know when each creditor reports to the bureau. If we could look at your credit, I think we could answer your question a lot better, but there's a lot of factors, and a lot of times people focused on one and something else is happening at the same time, but they're not, they don't look at it all the time, so they don't know. So, but those are some of the things that are kind of counterintuitive. Like, okay, I don't have any credit going. I've paid everything off. All my balances are zero. My score should be great. And that's not the case. That's my 2 cents on that question. Hopefully that helped.
Let me just add that revolving credit is very important because that one is, since revolving credit has all the interest, they want to see that you can make those payments on time. You don't have to pay the interest. If you pay everything off in full prior to the due date, you won't have to pay interest and you can continue to use and utilize that revolving credit, but it will make a difference. I'm working with a customer right now and she has a lot of credit, but it's all installment debt and her scores are low. So, and she also opens the accounts and closes them quickly. And that's another thing. So time history is a major factor. So 24 months is a really good, that's really what they want to see is 24 months. But to open an account and then turn around and close it is not a good thing.
Yes.
Don't close your accounts.
I know that the other thing is that a lot of times when I'm talking to people about their debt, they'll be like, I'm going to pay that all off. Don't you worry. I'm going to pay it all off. And I'm like, no. And the reason why we don't want people to pay out all off is that reserves is king. Like reserves is so important when you have reserves. Underwriters like reserves because is there enough left over to make the first 2 payments? Is there enough left over to make, if you're an investor, do you have 24 months, to cover the rent in case you need to? I mean, we look at reserves. It's really important. But yeah, Deanna made some excellent points there. John Miller, I see you're from Leonard, Texas. Where is Leonard, Texas? And you had a question. You asked the question, if your credit is up around 780, you're in good shape. And the answer is correct. Yes. I see that, Anthony, you answered it. Yes, credit's good. So I am going to move along. Great answers to those questions. And Are you monitoring the chat, Anthony?
Yeah, I'm monitoring it as we go.
Okay, do you know what's on your credit report? Do you check them annually? So this is a QR code to be able to do that. Y'all want to take a picture of this screen, you can. And we'll also send this link out when we do a follow-up email to this class. But I do find that a lot of people don't know what's on their credit report, or they haven't run their, looked at it, or don't even know if there's anything erroneous on there. We're happy to do that for you. But also it's just something that you might want to check out and take a look at. How much money do I need for down payment? It is the question every day that I hear. How much money do I need for down payment? So our team is the preferred lender for communities and schools of the Dallas region. And it's such an awesome group. And last July, I was doing a meeting for them, a couple hundred of their employees, and I was speaking, and we had a multiple choice question. And the question was, what is the minimum down payment for a conventional loan? And more than, and I don't, Anthony could probably speak to this, but it was like more than like 80% in the room answered that they had to have 20% for a down payment. And I almost fell over. And I think the thing is that I do this every day, all day. And I think that everybody knows. And then I forget that sometimes the news does not always report the accurate situation with real estate and mortgage. I know that's crazy, y'all. The news is perfect, right? It's all perfect. But I was very surprised to see that response. But the reality is you can do a conventional loan as a first-time home buyer with 3% down. Let's say that again. You can do a conventional loan with 3% down. I would say the most common conventional loan, especially for a first-time home buyer, is 5% down, but you can do it with 3%. We can do an FHA loan, Federal Housing Administration. That's a great loan product for a first-time home buyer, especially in the example of the question that we had that Deanna and all of us just answered. Because if you have your history, you don't have a long credit history, and it's not even so much a bad score, but if you've had one bump in the road or you don't have a long credit history, then what happens is you're probably more in line with what's called an FHA loan. They have a little bit more forgiveness for shorter credit history and maybe a bump in the road where credit is concerned, but they only require 3.5% down payment in that example. We love our veterans. I'm going to let Ben speak to a VA loan and a USDA loan since it's near and dear to his heart.
I wouldn't be here if it wasn't for the U.S. Navy. That's where my parents met. So we have a department just for veterans at Premier Nationwide Lending. VA loans are zero down loans. If you get up into the $1 million range, the VA actually can require a payment, but pretty much anything under about $650,000 these days, if you've got full entitlement, and you'll know what that is if you are a veteran, you can do a zero down veteran loan. USDA loans are rural housing loans. The only other type of loan we have is zero down payment. And it's driven by the property address, and it does have income limits. So the first thing you do if you wanted to go USDA is you have to go to the website and put the property in and see if it qualifies. It's rural, so just like it says, most of the properties are out of way, but a lot of times the cities, Dallas, Houston's of the world are growing faster than the census tracts catch up, and you might find a subdivision that's not really rural anymore that qualifies for USDA loans, and they won't usually last long, maybe a year or two, and then the stats will catch up with them. But sometimes you can get a USDA loan and it'd be pretty close to town. But they're great products. Neither one of them have a down payment, so we use those tools to help get a lot of people into houses.
So on the USDA, I've been doing it so long that I remember doing USDA loans, and I did a lot of them in Weatherford. And Weatherford now is no longer USDA. I used to be like, I used to have a company joke where it's like I wasn't doing a loan unless it was in Parker County. It was funny, but I did a lot of them. I think Sherman is still USDA. There's some different areas in Wise County that still are, but he is right. And I think Anthony was going to put it in the chat. But you do have to check it. And USDA is very particular on debt to income ratio. So we're always real careful on that particular product. And the only thing on a VA loan that we really, in Texas, the veterans are using that benefit. There's less than 15% that are utilizing their VA benefit for housing. We don't really know why that reason is, but it's one of my first questions I ask people sometimes. I ask them if they're a veteran. And I've had people say, yeah, I'm a veteran, but I just heard it was just too hard to do a VA loan. It's just too complicated to work with the government to do a loan. And that's simply not true. We're closing VA loans, 3 weeks, it's not hard to do. Kelly Campbell on our team orders your certificate of eligibility. So we'll take a look at it that way. But those are some loan products along that way. And I see that there are a couple of hands raised. I'm going to go through these next 2 slides where I get a break and then I'll get those questions answered. So closing cost and prepaids. In addition to the money that you need for down payment, there are other costs to consider. And this has, I'm talking about a placeholder here in terms of money. It really kind of just depends on what the purchase price is going to be. So for example, if you are purchasing a $400,000 house, 3% of that would be $12,000. Now, what happens is that trying to exactly figure out what you need is dependent on sometimes the area. It depends on your purchase price. There's so many variables, but the costs on how these things are paid is 3 ways: borrower paid, lender paid, or seller paid. So as the market has evolved and changed, I just closed a loan about a week ago or so. I saw Chrissy was on here earlier, about a week or so ago, and that contract it was a fairly sizable purchase price. That contract had $10,000 in seller contribution on it, which I almost fainted because it'd been a minute since I'd seen a contract with that much contribution. But all of the realtors that are currently on this call are going to ask the seller to probably pay for the title policy and the survey. And, a year ago or so, that was unheard of. The sellers weren't paying anything. So now the sellers are being in a situation where the properties are on, they're active longer. So the seller can make some contribution. I also been with a realtor recently where that maybe the house wasn't, maybe there were a couple of things that were minor that needed to be fixed. And those minor things that needed to be fixed really did not impact the value. So you could ask the seller to fix them, or you can ask for a seller contribution. This is why it's so important to have a home inspection. I did a video this week with Steve on here about home inspections. And that'll be coming to a Facebook near you, but you need a home inspection so that you know. And I love what Steve said, because he said, we don't know what is behind the walls, right? That's not what we do professionally. So reason why you get a home inspection is to find those things out so that you can be in a position to, ask for those things to be fixed, or for the seller to pay for them or provide a concession. Whenever a seller has a survey, and a survey is a lot and block drawing of your property. So whenever they have a survey, as a lender, if the title company accepts it, so do we. So that saves you, in some cases, at least $500. If you're in East Texas, that can save you even $1,000 or $1,200 not having to order a survey. Lender paid, we talked about that. Borrower paid, paying your closing costs. The closing costs can be any of these number of line items here: appraisal, title insurance. Again, they can ask the seller to pay your title policy, recording fees, things that are recorded with the county that tie you to the property. They're going to record the note and the deed of trust. 1 year's homeowner's insurance. We make sure that property has insurance for 12 months. I saw that on our post-closing department, Amber Wilson is on the call, and Amber knows this because in the post-closing, they always make sure that the house is insured for 12 months. She's giving me the head nod here. So, and then we collect taxes and insurance for your escrow account. And then when your payment goes out, that money from the escrow account goes towards that payment. And I show a screen on that here in a little bit too. Where will the money come from to purchase your home? So I talk about this all the time too. Like, we look at a lot of checking and savings accounts when we're going through bank statements. And, guys can use the chat. But one of the things I wanted to ask in the chat is, what do you think is the most expense that people have every month that just flies out of their account that they don't realize? I would love to see a couple people put that in the chat as to what they think that they spend the most money on that they don't realize. So checking and savings accounts, gifts, funds, Gift funds can come from a close relative, a mom, a dad, a close family friend. I even recently did a loan for someone that had gift funds from their employer, because their employer didn't want to lose the employee. So what better way to get them tied to them is to help them buy a house. And Kelly, that doesn't mean that I'm going to help you buy a house. I just thought I would add that real quick. Whoa, wait, hold on. 401k, you can get a loan against your 401k. There's called a hardship loan. So what happens with your 401k is what you do is the servicer that's servicing it. For example, Fidelity might be servicing it. And what will happen on the 401k loan is that there is what's called terms of withdrawal. And with terms of withdrawal, they can tell you what terms and to what amount you can take out. But here's the thing, a lot of people borrow against the 401k so that they can get into a home, and then they pay that money back. Sometimes you can just withdraw from the 401k and not have to pay it back. You can on a hardship. A home ownership is one of those things. Cash value of life insurance. I had a customer that had her parents had bought a life insurance policy when she was a baby. And they weren't continuing to pay in it. It was just dormant, but it had a value to it. And they said, she was trying to buy a home and they said, here, if you want to cash in this insurance? So you can do that. And in the cash value of that policy that she had was about $5,000, but she was able to use it towards purchase of a home. The sale of personal property. We love our better halves when they collect things like boats. Or maybe they bought a motorcycle that they're no longer driving or something like that. But you can have the sale of personal property. You can use that money towards down payment, and we source that with a bill of sale. There, again, I mentioned employer assistance programs. Some employers have different programs. And some employers have these programs and they're not going to like wave you down to tell you. Sometimes you have to look in the handbook and see. I will tell you that our team has what's called an affinity program or a preferred business program. So if any of you are aware of a company that's trying to implement a program, they could let us know. We've got a footprint for it already that we use with community and schools. IRS tax refund. Woo, woo, to the taxes. We're about to file our taxes, and if you're getting a tax refund, you can take that refund and put that in your savings account, and you can use that towards a purchase of a home. Second job. So we can't use a second job or a part-time income generating job to show as income, like a part-time job, unless you've had that part-time job for 2 years. But we can use that second job as we're showing you're collecting those as assets. So that's something that when you're trying to raise money to purchase a home, getting that second job, working a few hours is an avenue of thought. So mortgage credit certificate, you can look that up. We've had mortgage credit certificate for like 30 years and what that does, it allows you to have a tax credit for the time that you own the home. We love talking about mortgage credit certificates because so many lenders don't talk about it, but it's a very useful tool. And then down payment assistance programs. Our preferred down payment assistance program is TSHAC, Texas State Affordable Housing Corporation. We love that program. I serve on the advisory council for that program. You do not have to be a first-time homebuyer to use that program. And the balance of the state, income limit balance of the state is about $106,000. I think that's what's for Phillips area. In our Dallas-Fort Worth area and the surrounding counties, the income limit's $121,750. If you make $121,000 or less, and you have a 620 credit score or better, you qualify for that program and that assistance, up to 5% assistance. So it's a great program, and it's not a handout, it's a hand up to the process. I use that program a lot for teachers, for firefighters. Those are the kinds of, I really have enjoyed using that program a great deal. I'm trying to check the chat real quick. If you borrow your own funds, 401k, that payment does not count against your debt to income ratio. No, it does not. Oh, is that what, you answered
That was the answer. Yes.
Okay. Is there any question that hasn't been answered? Are we good? Oh, Steve, you win the prize. So Kelly, Steve wins the first prize. Cost of eating out. Yes. And Starbucks. Yes. So you send us an email with your address. She's gonna mail this book to you. And beer, I like that.
Beer, I
John
thought
Miller.
beer was the best answer.
Beer, John. Well, I think John should win too. Those two answers are great. So honestly, this is the true story. Like, I work with people and I look at their statements and look at how much they spend. It used to be fast food was affordable. It's not anymore, right? Yeah, no. And so I do look at a lot of that, and it says it just adds up. Subscriptions. Oh, Shay, that's a good one. Subscriptions. Yes. Subscriptions to things you don't even remember you have. Ben and I were just talking the other day. Why do we both have a Netflix account? Well, because we both got one before we were married. Well, we don't need two, So subscriptions, you got to keep a handle on that. And then this is the food for thought. What does it take to waste $10,000 a year? $27.40 a day of miscellaneous spending. How many of us have taken a kid or two to fast food and you went through $27.40 like that? It is crazy. Ben and I went and got 3 drinks today, I think, and a pretzel at Sonic, and I spent $11, $11. So we just become more and more cognizant of that. So just something to think about. Food for thought. $27.40. $10,000 a year. There's your down payment. How much can I afford? I know we've got about 10 minutes or so, so I want to make sure we finish on time. This is a debt to income analysis of how much you can afford. So your combined monthly income, and again, everybody's situation is different. So this is just an example so that it helps to clarify, but your income might be less, it might be more. Your combined income of your household might be less, it might be more. But the combined monthly income in this example is $8,000. What we prefer, on debt to income ratio, we prefer the debt to income ratio not to exceed 45%. Have we done loans where the debt to income ratio was higher than 45%? Yes, we have. On a VA loan, we've done a debt to income ratio and do debt to income ratio as high as 55%. So I would say that our preferred way is 45%. In this example, 45% of $8,000 is $3,600. Now, everyone has monthly obligated debt. Some don't, but your monthly obligated debt, this is just an example. Let's say you have $200 a monthly obligated debt for credit cards, $300 a monthly obligated debt for a car payment. I think car payments now are crazy, much higher than that. Student loan debt, $400 a month. So then your total debt is $900 a month. So monthly obligated debt that is allowed, the monthly debt that's allowed to be 45% debt to income is $3,600. $900 of monthly obligated debt minus the $3,600, 900 minus 36, $3,600 minus 900, it's been a long day. Amount allowed for housing is $2,700. So when you are looking for a mortgage, that's the conversation that we're going to have is, okay, we need to stay in this parameter of what the payment is going to be for the area that you're going to buy. And this just kind of gives you a pie chart: credit card, car payment, student loan, housing, things like that. I do see a hand raise. Do you want to put that in the chat? Unmute real quick. Shala?
I can put it on the chat or I can just ask you. It's up to you.
Sure.
Okay, so this is in regards to the closing costs where you mentioned that sometimes the lender could pay it.
Yes.
So my question is, they could pay it, but would it be added to your loan?
It's not added to the loan, but sometimes when we do lender paid closing costs, it does increase the interest rate. So if the interest rate was, and I'm just throwing this out as an example, but let's say the interest rate is 6.5% and you need 1,000 in credit or 2,000 in closing cost credit to make the deal work. Maybe the interest rate then becomes 7 or 7.5. I'm just talking about today's rate. So it doesn't necessarily, it's not financed in the loan, but it will impact the rate if the lender pays closing costs. Is that a good answer? Anybody want to jump in on that?
Okay, no, I got it. And also, okay, this might not be a question I should ask here, but
no, please.
Is it true that Bank of America is giving up to $40,000 just given out as a grant to buy homes?
So I can see the reactions of the realtors on the call. So Bank of America doesn't actually give away anything, but but I can't really speak to what another lender does. I think sometimes some of the bigger banks have some products and some programs, but they're from time to time, I think sometimes those programs, have difficulty closing on time. And when you're in this type of market, you need to be able to fulfill your contractual obligation. So I'm trying to be delicate, right? I'm on a call, but yeah, I'm not aware of a program that gives 40 grand. So sign me up for that. Yes.
Okay, and do you have time for another question?
Sure.
Okay, so as far as the down payment, let's say that you, I don't know, earn 60,000 a year, but you have a pretty good amount of money saved, for example.
Sure.
If you qualify for a loan, let's say because you're a police officer or firefighter or teacher, can you qualify for the down payment assistance based on your income and not necessarily what you have saved?
That is a great question. It's like I begged you to be on the call because you have such great questions. That is an absolute great question. When you on the TSHAC program, for example, they don't judge, they don't even see what is in your account. And I've had people that had plenty of cash reserves and they just didn't want to use them and they qualified. They were a firefighter, they were a teacher or whatever. They were getting gift funds from parents and they wanted to make sure that they had money left over to buy other things, furniture, whatever it was. So you're not, that is not an issue on the down payment assistance programs. Now, there are some situations where like USDA, they do care. So if you have enough in assets to put down 20%, USDA, that won't work in that situation because they do care, because they look. The down payment assistance program, if you qualify it based on your credit score and your income, then it doesn't matter what you have in reserves.
Okay, thank you.
When I say reserves and assets, I'm saying checking and savings account. That's what I mean. Great questions. The conforming loan limit. So when you hear people say conforming, the conforming loan limit means what it fits in a Fannie Mae, Freddie Mac conforming loan limit. So the conforming loan limit that came out for this year was it doesn't become a jumbo loan unless the loan amount is more than $726,200. And then FHA, the FHA in the Dallas area is a little bit higher than this, but your basic FHA to fit in that product, $472,030. And you can use, by the way, assistance programs with either one of those programs. What's included in your monthly payment? Principal, interest, taxes, and insurance. So principal, interest, taxes, and insurance. Principal, what is the amount the borrower that's borrowed to purchase the home? And that goes in, that payment goes towards the house. And then the interest on the loan, the percentage of the principal based on the interest rate, the taxes, property taxes, and also then your insurance. Your property taxes and your insurance, we will escrow that money if there's not 20% down. When you put 20% down, if you don't want to escrow and you just want a principal and interest payment, you can have that. If you don't put 20% down, you have a full payment, principal, interest, taxes, and insurance, and that taxes and insurance is escrowed, and then the money is paid out annually for the insurance of the money that you have then put in. If you purchase a home in, let's say you purchase and you close in March, then you won't have a mortgage payment until May. I was working with a customer today and they're hoping to close in April. Their mortgage payment then won't be, their first payment won't be until June. Your payment is due on the 1st. I know you'll see a lot of things where you have this grace period and all that kind of stuff. The payment is due on the 1st each month. And I don't know if anyone else wants to speak to anything else on this slide. Are we good? I'm going to move on. I love this guy. Taxes. Woo! How many of us love taxes? That would be a no. It's tax season. So here's the thing. When you're thinking about purchasing a home, and you have purchased a home, it is such a much better idea to work with someone to help you file your taxes, a professional. Create a tax folder, strategize, talk to a tax expert. When you own a home, it is so hard when you don't own a home and you're renting, but to understand what I'm about to say, but when you own a home, the property taxes and the interest on the loan are tax deductible. And you're currently renting, you don't know what it feels like to have that tax deduction. And the first full year of that tax deduction is going to be a huge impact to your, tax liability. So and like I said, tax deduction. So I always tell people, one, strategize, talk to a professional, but the benefits of owning a home versus renting, you can have a mortgage payment that's actually higher than your rent because you have the tax deduction. How do I get started? These are the things that you need to do. These are typical items that are needed for a pre-approval. One, we need a complete loan application. So when we are taking a loan application, an online loan application, and we'll show you a screen for that, we're taking an online loan application, we need it to be as complete as possible. Personal information, where you live, where you work. We for guideline purposes, we need a 2-year history of where you've lived and a 2-year history of where you've worked. You don't have to have worked in the same place for the whole 2 years, but if you've worked in a place for a year and then prior to that you weren't working and prior to that you were working, we need to be sure that we have a collective 2-year history just of where you've worked. It doesn't have to be necessarily in a row. We don't want a lot of gaps in employment, but we do have to have that in order to meet the guidelines for loan approval. We ask for current pay stubs, or we have an automated system pulls employment. We need to reflect a 30-day period for earnings, via pay stubs or our automated systems. 2 years tax returns if you're self-employed. If you are self-employed or 1099 working for a company, we were going to ask for 2 years tax returns to calculate income. W-2s, we'll ask for 2 years W-2s. A lot of times if you're a W-2 earning person, we may not need, so therefore we don't ask for tax returns. I was working on a doctor loan today. He's actually an employee of the, of the practice. So he gets W-2s. I don't need the tax returns in that example. A photo ID that's not expired. So this is so important. Please don't show up to your title company with an expired driver's license. So we need a photo ID that's not expired. Driver's license, passport, those are the things that work. The most recent 2 months asset statements for all accounts that we're using to qualify. So you're checking your savings, your 401, anything that we want to source as income, a source as assets, we're going to need a copy, or again, we have an automated system for that, and then we can send you the link to set that up. But we do go back 60 days to source that. We don't want unusual deposits in those accounts. We have to make sure that we have that information. When we have a Premier Express program, that is a process that we have incorporated when we have a full automated scenario. And also if you're in a situation where you're putting down 20% and we have an appraisal waiver, then we'll do all of that underwriting in the same day. And we use our certain financial institution to get that information. So it's kind of an express program. We don't really need any documentation. We have it all. It's all automated. And then if we have an appraisal waiver as well. So here, this is my screen. Caution. I'm going to let Philip talk about the caution screen because he's had some experience lately.
Sure. Thanks, Stacy. Talk to your loan officer before you do any of the following. Change employment. I want to put in a little note of this. I had a customer that once decided to become self-employed on the week of the closing. So needless to say, we did not close that loan because they chose to do that at that time. Significantly increased credit card balances. Yeah, please be aware of that. This is going to affect your credit, it'll also affect your cash to close, it'll affect your debt to income, and those can turn this into a adverse loan because of those measures. Reduce asset balances. So what we're talking about there is, like if you were to pay off the balances on some of the things that you owe, large deposits and withdrawals or factors. Fail to disclose all debts. If you don't disclose all your debts, then that can become a problem because we find out later that you had this judgment or you had a personal obligation that wasn't on the credit report. And then things get uncovered in underwriting. And now we have a loan that is no longer approved. Apply for new credit. This includes buying furniture, everyone. Do not finance furniture until after your loan is closed. This could kill your deal. Don't go out and buy a vehicle. Don't even shop for anything that will run credit. Make large undocumented deposits. Large deposits, if you put a large deposit of cash in your account, we have to source it. And that could become a problem in underwriting. We don't want to do any large deposits or withdrawals. Change banks, we have to provide bank statements. So if you change banks, then we're having to get the old bank statement and the new bank statement and show where the funds have transferred over. That is not impossible, but it's very problematic to navigate. Move money from one account to another. If you do that, we have to show where the funds came out of account A and went into account B. It's not something we can't overcome, but it's problematic. Best to just leave it where it is. Don't go and co-sign a loan. If you become a cosigner for a loan, it's just the same as if it's your loan. So if you cosign for your family member a vehicle, it is the same as if it's your loan in the eyes of debt to income and obligated payments for you.
You did such a great job, Philip. We've all, in all of our history of lending, we've had something happen to all of us on this scenario. I've had someone put a large deposit in their account in the last week of the loan. And then the large deposit in this example was a foreign wire transfer from Colombia. Please don't do that. I know that relatives and family that like to move money back and forth. What we try to do, the reason why we go over this list is we want this to be such a beautiful transaction and such a smooth transaction for you. And we want you to be successful homeowners. We don't want it to feel challenging. We don't want this to be heartburn. We want this to be heart success, and so that's why we kind of go over this. Again, today on the phone, it doesn't matter what profession you are, a teacher, a firefighter, a doctor. So today on the phone with a doctor, I had to specifically ask about some specific debt. And that it wasn't disclosed anywhere else, but it was still debt and I needed to know. So, that's why we share this list. Having your own realtor is so important. I know that we are going over by more than a few minutes, and I'm sorry for that. I know we've had some great questions, but having your own realtor is so important. And what I would like to do, I don't know if, let's see, I know a lot of people had to drop off because they lost connection. I got several text messages. So realtor wise, I see Steve is still here. Steve, do you want to just touch on like 2 points and also explain how your commission is paid, please, sir?
Thanks, Stacy. So number one, right now, currently in the state of Texas, my commission is paid by the seller. No matter what commission, whatever that commission is, the seller pays it. Or if we're talking about a new construction, the builder ends up paying my commission. So you folks on the phone who are thinking about, geez, I have to consider paying my realtor X amount of money, for the sale. No, you don't have to, because that's covered by the seller. A cup of coffee would be nice every now and then, but the seller will pay for my commission. And you had another one you wanted me to tackle. Which one was that?
Oh, I think that's good.
Okay.
The real estate knows the market. They have knowledge of the market. They're, when people try to do their own deal, they're in a contractual agreement, and the real estate agents can take the emotion out of the situation. The real estate agents schedule the closing time. They can point out things. I know this picture kind of shows someone pointing something out. They look at it with a different lens. Here's the thing. They don't want you to buy a bad house because they're going to try to have to sell it in 5, 6, 7 years. And because you're going to call them back to list it. So they want you to buy something that has value and that has good bones.
Sure. Hey, that's, I don't mean to cut you off, but that's actually a really good point, because what a lot of people don't realize, they see a lot of for sale by owner signs around. Actually, nationwide, something like 98.3% of homes are sold with the assistance of a realtor. So that realtor works for the seller. As a buyer, you don't want to go into that business arrangement with the buyer and the the seller and the seller's agent on your own. You want somebody in your corner to speak for you and to make sure you don't get taken advantage of.
I mean, it's just everything that Steve just said is so true. So, and then contract to closing, again, you're entering a contractual agreement. It is good to have a realtor on your side. We work with a lot of them. And the ones that we work with do a great job. This is contract to closing to ownership. Real estate purchase contract is how that starts. We then disclose with like initial disclosures, and then we start talking about the interest rate and locking the interest rate. And then while certain things are happening, while the loan is cooking, and why I say it's cooking, there's a little bit of time frame in there while we're processing and underwriting the loan. Kelly's ordering an appraisal. We're ordering title work. We're setting up insurance. Then there's a qualification process. And then when it gets to the end and we have what's called, we're ready for closing or ready for docs, then we send out a closing disclosure at the end. And then after you've received that closing disclosure and signed it, we can close within 3 days. Then we get all the final documents, we cover those, and then we have closing day. You sign documents at the title company. Usually, it does require taking some time off work. Closing on, going to a title company is preferred, and making sure you're available during work hours. It's not your home until the loan is funded. So once you sign, then with the seller signs and then everybody, all the wires for the loan and all that kind of stuff. Well, once the loan is funded, then you can have the keys. So you don't go sign and then go apply for furniture. You go, you sign, and then you wait for the loan officer to say you're good to go. And then I did a credit podcast with T-Shack. This is about 30 minutes long. If you want to take a picture of this, I think Kelly or Anthony might send this link out with the email when we do the follow-up. But I love this podcast. It's a great podcast on credit. It was about 30 minutes long, and you can listen to it in the car or whatever. On our YouTube, it's Stacy Lynn Mortgage. So at Stacy Lynn Mortgage is the YouTube channel that all of the classes that we've done, and every class always ends up with some different questions. So you can go to YouTube and you subscribe. It's free. And then that's a treasure trove of education classes that are on that site. The last thing I wanted to share is this is where it starts. And all of our stories have starts. And this is my grandfather, Donald Schriever. He fought in World War II. And then he came back after fighting in World War II, and he met his son, which was my dad. When my dad was 3 years old, it was the first time he saw his son. And Donald Schriever went on to become a teacher, and did some amazing things. And my grandparents were in Waco, Texas when I was a kid. And I will just share with you that he was of humble means, but contributed. And so did my parents contributed. And some of you are in situations where you are contributing to your community, and we want you to have the luxury, if you will, and it's not really luxury, but we want you to have the home ownership, because that's what this guy here and so many other people fought for. They fought for the right to have home ownership so that you feel protected in your home. That's why people are wanting homes, especially during the COVID era. They want a place to call their own to raise their family. I can't say enough about it. My mom, like I said, is living in the home that is the only home that they owned. And if she's known you for more than 5 minutes, that she has granite countertops. So we've remodeled her house with granite countertop. My mom also, and Kelly will hold it up, but my mom said every time we get a chance to speak to people, we need to take them flowers. Well, that's not possible, but we do provide them with seeds. And I like bluebonnet seeds, and Kelly's holding them up because I like it for us to be able to grow together. So if you shoot us an email with your address, Kelly will mail out some bluebonnet seeds to you and your family. But again, everybody's story has a start, and we just want to be able to have you be successful. This is our team, and everybody in this team, we're our team, Oklahoma, Louisiana, Texas. We have core values to our team. This was what we did in December, and our team has a lot of faith. We believe in our family, accountability, integrity. We're driven and we are committed. So some of us some days feel like we should be committed, but we are committed to our customers. So that kind of gives you a little bit of our team and information for that. And at the end, if we love for you to leave us a review, and we love for you to follow us. We have our Facebook, our Instagram, our LinkedIn, and our YouTube. And we're grateful for the time that you guys have spent with us. Is there anybody that have any last questions? Like I said, I know we went over, and I've gotten a lot of text messages of a lot of drop-offs because of the signal. So if anybody has any questions, I'm happy to answer them, or any further input. Ken, did you have something you wanted to say?
I would just summarize all the things not to do. If you have questions on credit or paying off a debt or moving assets, or call your loan officer, talk to them before you do anything, and they'll inform you what to do.
Right. Yeah, there were so many people in different areas I saw in the chat. So I appreciate everybody getting on the call and being part of the call. If you were invited to the call by your real estate agent, please get in contact with them. Reach out to us. An online application is very simple to do, and then we can redirect to the person in the area to take care of it. But I've enjoyed it. I've enjoyed all of y'all, and be safe out there. Like I said, in the middle of this call, we had sirens. So I don't know what it's like at Robeson Ranch there, Steve, but be safe. And we just appreciate everybody's time. Y'all have a great night, and I appreciate it.